And I want to welcome in our next guest, Ted Thatcher, joining us to take a more macro look at the markets. Ted, of course, the president at Bright Lake Wealth Management. Great to have you with us, Ted, as always. You know, we're starting another week. We're in the red to kick this one off as well. Dealing with a lot right now in the markets. A lot of headlines, a lot of data to sift through here, a lot of AI investment boom conversations and what that means for the markets. What do you think is the single biggest driver of volatility right now?
You know, Marley, I think the first, second, and third thing the market is worried about today is what's going on with the price of oil. If you miss a little, you miss a lot in this market right now. If we rewind the clock just to make sure the audience is with us through all these phases, to last week, we had the largest week over week gain in the price of a barrel of oil that we have had since 1982 in the data on record. 14% of that coming on Friday out of a 34.5% week. Then oil markets open on Sunday and we see prices get to almost $130 a barrel before retracing after there was some discussions from G7 countries about whether they would put 400 million barrels of oil into the marketplace from all the strategic reserves. Then we see the France's finance minister come out and say that they're not quite ready to do that. And of course, you saw the spike again here this morning. And so pretty quickly, when you see all this volatility in the price of oil, you have to start saying, okay, is this going to just be affecting us at the pump, or is it going to affect really the consumer much more broadly than that?
And Ted, I want to talk about where we sit right now. You did a great job highlighting some of the movement that we've seen in price. But right now, we're right at that $100 mark. I'm just confirming we're still there. We've dipped just slightly under it right now. We're just below 99 at the top of the show. We were over 100. But that number is so psychologically and economically important. It seems to be that big round number. Why do you think that is?
Well, there's several reasons, but I think for consumers specifically, for every $10 a barrel of oil increases, we see about 20 basis points increase potential in inflation. So imagine the CPI going up about 20 basis points for every $10 of increase in a barrel of oil. And so when you saw that spike yesterday, and even still at this $100 level today, we have to say, okay, well, if this conflict continues and we don't get out of this conflict pricing stage of the war in Iran, we're going to be fast forwarding 3 months from now saying, okay, hold on, we're seeing CPI prints that look more like the COVID inflation numbers than the nice trend down that we have been seeing.
And so as we look at this, you've cited a couple really good things in the notes that you sent over that I want to talk to you about. Mm-hmm. You've talked about that this is also a logistics war. We're not just keeping a close eye on the actual price of oil. There's so much more that goes into that in this inflation conversation. Shipping costs, insurance premium, who's supplying that insurance? Is it the U.S. government? Are we outsourcing it privately? How sustainable is it, depending on how long this carries on for? Supply chain disruptions feeding into global inflation. Take me through the logistics war component here.
Absolutely. So there are several, of course, the conflict itself, drives this. But, beyond that, it is a logistics issue. The reason that all these ships are caught inside of the Strait of Hormuz and can't go past right now isn't just because of the hot, military consequences here. It's because all the reinsurers, the primary insurers of these vessels, have completely pulled out because they just can't take the mathematical risk. And so, of course, we saw, what the U.S. has tried to do here. Trump has said, hey, we'll see that the Navy can, essentially chauffeur some of these vessels through the Strait of Hormuz. They said, okay, well, we'll look at, being an insurer ourselves with $20 billion up on that. But it's just not enough, and it's not happening yet. And so until we can get those insurers back into the marketplace, my concern is that that bottleneck is going to persist.
And Ted, as we're still dealing with these geopolitical shocks and keeping our eyes on these oil prices and the uncertainty around this conflict in Iran, we also got some very important data last week. Unemployment up to 4.4%. We had that surprising loss of jobs in the month of February. Some noise in the report, but even with the noise, still would have been a surprising loss here. As you look at that data, how should investors interpret that, particularly with the uncertain background that we have behind it right now?
When it comes to the jobs data, the consumer is getting it on both sides. They're worried about inflation again, and now hey, we saw some highlights in January on the job side, and then to your point, a surprise 4.4% unemployment reading. I think that what's driving this concern really is, of course, the whole discussion about AI. Is it coming for every single white collar job here in the next 18 months? Is robotics coming for every blue collar job shortly behind that? We've seen in the last couple of weeks, I think 2 or 3 different think pieces now that have been widely dispersed. Really, I think with a really doomer narrative as this whole AI jobs discussion happens. And then to boot, we saw Jack Dorsey, the CEO of Block Technologies, of course, his tech firm laid off 40%. Of their employees due to AI. So I think that is really the fear, if you will, discussion around the jobs market right now.
Certainly a lot of fear discussion around a lot of different topics I could throw at you right now. But as we live in this sort of caution and fear-driven environment, I know you always have some picks for us about where you see some potential opportunity. Where are some opportunities in the market right now?
Marley, there is a lot of ways to take this question. The sectors, you can always follow the money, right? Where are the, tailwinds in different sectors right now? Of course, materials, consumer staples has performed really well year to date. But, I might take this question a different angle. There's been such a discussion around the valuations of these mega cap companies the last year and a half, not being accessible to everyday consumers. And a quote comes to my mind from the late, great Charlie Munger. He said, if you just bought amazing companies on the 200-week moving average, you would drastically outperform the S&P 500. The problem is most people don't have that kind of discipline. And if you look at where Microsoft is right now, it's at $400 a share. It's sitting just off of that 200-week moving average. And so when I was looking at that this morning, it did come to my mind what Charlie always said. And I think that may present an opportunity for investors if you're looking at some of those mega cap names.
Ted, it's always such a pleasure to have you on the show. Thanks for bringing that macro look to us and also for some potential opportunities in the marketplace right now. We appreciate it. Ted Thatcher, the president at Bright Lake Wealth Management.